Are you looking for a tax-efficient route to generate regular income? Well, look no further than the SBI Dividend Yield Fund. So in the stock market, there are some companies which regularly share their profits with shareholders in the form of dividends. These dividends could be paid at various intervals, and sometimes a company may also announce a special dividend which is higher than normal. So how can you find high dividend paying companies? Judging the dividend paid by large, mid and small companies in absolute terms would be like comparing apples to oranges. So what savvy investors do is they calculate the dividend yield, which allows them to judge dividends across companies on a level playing field. So dividend yield is calculated by taking the amount of the annual dividend paid and dividing it by the stock price. For example, if a company has declared a total dividend of 30 rupees in a year and its stock price is 600, then the dividend yield will be 5%.
Some of the key attributes of such companies is that they are relatively more mature businesses with an ability to generate healthy free cash flows. They are relatively less prone to downside risk in falling market, coupled with capital appreciation prospects in a reviving market. Dividend yield companies also reflect optimum usage of free cash flows, good operational health, and sustainability of future earnings.
Research shows that high dividend yield companies also limit the downside risk, and thus they are better placed to weather economic downturns. So when we studied the maximum drawdowns of 3-year periods starting from 2008, we found that only once, between 2014 and 2016, the Nifty Dividend Opportunities 50 Index fell more than the market. In all the other 3-year periods, its maximum drawdown was much lower than other indices like the Nifty 100, mid-cap or small-cap. Historically, during major market falls, high dividend yield stocks have provided a cushion against market volatility, thus bringing stability to your investment portfolio in comparison to the broader market. In fact, a comparison of the Nifty 500 and the Nifty Dividend Opportunities 50 Index shows that an initial investment of 1 lakh rupees made in 2008 will grow to 5.74 lakhs in the Dividend Opportunities Index compared to just 4.2 lakhs in the Nifty 500.
High dividend yield companies are also generally well placed in terms of valuations, which means that the stock price is not expensive. Other things being equal, a higher dividend yield generally means a lower price to earnings ratio. This, coupled with strong fundamentals, offers a compelling investment opportunity for investors.
The SBI Dividend Yield Fund will invest in stocks across market capitalizations, sectors and styles.
We will use a bottom-up stock picking approach which will identify businesses with attractive dividend yields and future potential growth in dividends. We will also explore some opportunities in REITs and InvITs. The overall endeavor is to construct a portfolio with aggregate dividend yield that is at least 50% higher than that of the Nifty 50 index.
And here's the best part for those looking to use this route to create a potential regular income. So if you create this regular income by investing directly in stocks of dividend yielding companies, then you should know that 10% TDS is deducted on the dividend proceeds and they are tax exempt only up to 5,000 rupees. Beyond this, they are taxed at the prevailing slab rate. For those in the highest tax bracket, this could be as high as 35.88%, including cess and surcharge. Forget direct stocks. Even if you opt for a dividend yield mutual fund scheme, but you choose the income distribution cum capital withdrawal option, your tax liability will still remain as high. But what you can do is choose the growth option and create a systematic withdrawal plan where the maximum tax liability of capital gains will be 17.94% for the short term and 11.96% for long term, including cess and surcharge. So let's assume that an investor has invested 10 lakh rupees in direct stocks as well as a dividend yield fund, which will seek to generate income via the SWP method. So if we take, say, a 6% dividend yield, then both options would yield about 60,000 rupees annually in the form of dividend if you're invested in direct stocks, and redemption proceeds if you have invested in the Dividend Yield Fund SWP option. So in the case of direct stocks, the annual tax liability would be 21,528 rupees, which would total a whopping 1.07 lakhs or 35.88% of your net cash flow over a 5-year period. Now, let's explore the SWP option. Here, for the sake of simplicity, we assume that the initial investment was made at an NAV of 10 rupees and this NAV increases by 10% annually. We also assume that the taxation is long-term capital gains. Therefore, the tax liability comes to a meager 8,677 rupees over a 5-year period, or less than 3% of your total cash flow. However, it is best to consult your financial planner or advisor to understand the tax implications of any or all investment decisions. Do remember that the NFO of the SBI Dividend Yield Fund is open for subscription between the 20th of February and the 6th of March. So do contact your advisor or mutual fund distributor to invest in this scheme. You can start with a monthly SIP of 500 rupees or a minimum lump sum application of 5,000. Thank you very much for watching and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.